Very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Coghlan, and I do hope everybody is well. Good to see you, Gavin, Johan, Suneth, Sunil. Good to have you here. Just as other folks are coming in, don't forget as we look at different entries, exits, the whole idea of this workshop is you're looking over my shoulder, seeing how I go about making trading decisions. This is not trading advice; it's from an educational perspective. Those regulars know exactly how this works. And today, of course, we are looking at how to trade the US CPI print tomorrow. So just a couple of things to say. Hi, Gavin. I hope you got a reminder for this webinar. I've been thinking about you since you didn't get the reminder for the Monday webinar, and I was wondering if this has worked out okay. I've had a tech problem my end as well. I've been changing over computers and I've been locked out my HYCM email, so I haven't been able to get back in. So I hope you got a reminder. Oh, excellent. Good. I'm pleased. I was thinking about that. I was thinking, oh, I hope Gavin got sorted. Good. You're all sorted. Excellent. We had a change of the webinars here as well, our end. So some people have been impacted. So I'm glad that's worked all right. Okay. Hello, Ignatius. Good to have you. Nuno. Just as other folks are coming in, yeah, very warm welcome. Okay, the US CPI print. This is a big one, and there are some good opportunities that are worth looking at here. So it's definitely a good data point, and I can see potential opportunities both for a miss or a beat in the data. And in order to understand the opportunities that are here with this data point, we really do need to have a sort of a bit of a wider grasp on the market dynamics that's happening. So as usual, I do want to start with the big picture, because it's often in only understanding the big picture we can find those short-term opportunities. This is a short-term opportunity market with so much uncertainty regarding US recession, how deep that US recession might be, how high the Federal Reserve is going to be hiking interest rates, if they're going to pause, when they're going to pause, how long they're going to pause. You know, these kind of questions are in abundance, and there's sort of analysts on the extreme of both sides taking fairly different views. So it's quite a spread of views, but the general consensus I'm going to outline to us so we know exactly how to position ourselves if we see a surprise. So the first thing for us to look at is what the Fed's expecting as opposed to what the market is expecting. So I just want to give us that indication here. Now, let's take a look first and foremost at the Federal Reserve expectations. Now, at the last December meeting, remember, the Fed is expecting now to have no rate cuts all of this year, and they're expecting the median rate to be at 5.1% for all of 2023. So this was a very hawkish tilt that we saw out of the last Fed meeting. And we've seen a continuation in the Federal Reserve repeating to markets, we are not looking at cutting interest rates in 2023. We need to bring inflation back down to 2%. And with inflation being so high, and inflation is over 7% headline inflation in the US, which is more than triple the stated 2% target. So the Fed are saying, as it were, look, markets, I don't know why you think we're going to be cutting interest rates. We want to get inflation under control, and we're not looking at cutting interest rates at all this year. However, the market is saying, no, no, no. We don't believe you, Federal Reserve, and we're expecting you to cut interest rates this year. In fact, we're expecting you to cut interest rates twice this year. So you see the market, and these are the implied interest rate curve. What the market's expecting is the Fed to peak around 5%, which you can see that does roughly coincide with this dot plot, you know, 5.1%. So just slightly above 5%. Market saying, okay, we see around a 5% peak as well. But the dot plot says no rate cuts till 2024. the Federal Reserve short-term interest rate curve shows, oh no, we're expecting 2 rate cuts by the end of this year. You see, at the moment, markets are expecting that to drop to 4.42%. So that means the recent dollar pricing that we've been seeing going into the end of last year is what? On 2 interest rate cuts coming from the Federal Reserve this year. That's why this dollar has just been sinking, and we saw this trend line that was very convincingly broken to the downside and down through that 100 exponential moving average of traders just saying, no, we are seeing the Fed cutting interest rates twice. That's the big picture. Now, let's drill down into the micro picture. Now, the micro picture is this. Running into Friday last week, we had strong ADP jobs numbers. Do you remember? And that increased expectations that there would be a strong non-farm payroll. Now, in the event, the non-farm payrolls were strong. And what we saw, if you remember, is dollar strength into Friday last week. Do you remember here? We saw dollar strength into Friday last week, and then we saw the dollar sell off on Friday. Why? Well, that was partly because there was a little bit of a buy the rumor, sell the fact response. You see the non-farm payroll came out at 130. So look, the data was good, but was it, market moving sensationally good? No. And investors were already expecting a good number because we had that strong ADP jobs data on Wednesday. And remember, ADP is basically a payroll exercise between one of the biggest payroll companies in the US, ADP, teaming up with a data analytics company, and they try to work out what the jobs is going to be for the US. Now, this was important for the US because this is December's data, and notice it comes out the 6th of Jan, so it's the first indicator of how the US is doing. And remember, the US economy is a service-driven economy, and the majority of the US's GDP comes in through wages. So jobs data is crucial for letting us know how the US economy is doing. That's why the market's so focused on it. Now, on the event, we had the strong data point, and we saw a buy the rumor, sell the fact response. So this made perfect sense. I personally was buying the dollar into the non-farm payroll. I closed out my dollar longs just up around these highs, just around this 1.540 region on this chart. Great, well done me. But then I'm not saying that to brag at all. That's tongue-in-cheek. Don't mistake me. But the serious point I'm trying to say is there's a learning point here, because look, the non-farm payroll came out at 130, and you can see it suddenly sold lower. And in fact, let's just drop down to a 15-minute chart, and it'll be clearer. Okay, so we had that 130 print. There it is. Oh, the dollar sells off. Why? Because it was buy the rumor, sell the fact response. Okay, so we had the dollar sell off. Just people going, oh, okay, it's not going to be an amazing print. So is that going to change anything? No. I'll book profit on those dollar longs I had. You might have held it through the NFP thinking, could we get an amazing reading and get another leg higher? And then traders have thought, nah, that's it. I'm closing out. Okay, so closing out those longs. Then there's a bit of a rally, which you just kind of expect. There wasn't any particular massive reason to be selling the dollar, and buying the dollar made sense. But this 3 o'clock reaction, do you see how we had from 3 o'clock? Where are we? We had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. In about 12 hours of price action, we had about 9 hours of selling, and couple of hours of marginal buying, approximately in one sort of nothing, okay, around the close. So what does that tell us? It tells us that the dollar selling was quite pronounced, that came in towards the end. Now, why? This is the crucial bit to understand. And the reason was because of this services PMI print. Now, with growth potentially slowing, and that's what investors are looking at this PMI data. It's Purchase Managers Index, and it asks questions like to service managers, do you see business growing in the next 12 months or shrinking? Are you expecting to hire more workers, or are you expecting to reduce your workforce? Just general questions, but they give you an indication of where the service sector is heading. big misses. An on aggregate miss, and the business activity components below the lowest expectations, and the headline below the lowest economists' expectations. So in other words, surprising to the downside. Alarm, alarm, alarm. What does that tell traders? The traders say, aha, see, we were right. Growth is slowing, and that means that our projection here of 2 rate cuts is closer to the truth than the Fed's projection of no rate cuts this year. So that means dollar selling. Hence, we see significant dollar selling on Friday. This is now a daily chart, and we saw that flow over into Monday, and we saw stocks gain, and I personally went long S&P 500 stocks on Friday into Monday and just taking profit on Monday. Short, sharp, sweet kind of, outlook. All of that made sense. So quite confident here that we got into how the market's feeling. Then we had Tuesday, and what was anticipated for Tuesday? Fed Chair Powell's speech. Would he indicate, would Powell be saying, listen, no rate cuts 2023, or would Powell be saying, actually, maybe the market's right, we will have to cut rates for, twice? Obviously, it's not going to be as crude as how I presented it, but what it does tell you is that was the question that the market was looking at. Powell's pretty silent on US monetary policy. So once that event was out of the way, stocks were able to rally, saw the dollar sort of, bit more selling came into the market, nothing major. Now we've got really nothing burger, and that leads us to the inflation data that is due out on Thursday. Now this is interesting, okay? And don't forget, do check out my blog, HYCM blog. You get loads of really good information here. And on the inflation data point, I've got an article, US inflation data on Thursday. So this is the core. The last core reading was at 6%. The last headline reading was at 7.1%. But you see, the headline US inflation is trending lower. Core is what arguably trending lower. Okay, expected to fall to 5.9% from 6%. So at the moment, the incoming data has been showing falling inflation. Now the Fed want to see inflation trending lower. And if the Fed see inflation trending lower, what does it tell them? It tells them, good news, maybe we can move in line with what the market's expecting. Maybe we can start cutting interest rates so that we don't stifle growth too much. Remember, you can't support growth at the same time as fighting inflation very easily. Because if you hike interest rates, you control inflation, but you risk stifling growth. But if you cut interest rates, you prompt growth, but you end up potentially flaming inflation. So it's a central bank is pretty much hands tied. The only way that a country that I can see can do it is really say interest rates don't do the heavy lifting, but government policy starts to crimp demand through higher taxation, things like that. So maybe the federal, a central bank working together with the government can handle inflation much more easily than a central bank can just by the hiking or otherwise of interest rates. So now that means there's a very nice picture for us on Thursday. So here we go. The core inflation is forecast actually to fall down to 5.7%. I think that's actually been revised lower. I think that was 5.9, unless my glasses were betraying me. And the headline is expected to fall down to 6.5%. So do you see that really at the moment, the market, is expecting lower inflationary readings for Thursday at 1:30. So that means the best opportunity will come from a big surprise to the upside. Why? Because then these market participants who are saying 2 rate cuts this year will say, oh, no, we got it wrong. Inflation is worse. We will have to revise our forecasting. That will support the dollar. So this is what I'm looking for. if I see headline inflation coming in above 6.8%, and especially if it's above 7.1%, if I see core coming in above 6%, then I would expect some immediate upside in the dollar, and I would trade that just simply with the euro US dollar. So I would simply trade euro US dollar to the downside, and you can see here the euro US dollar is sitting around this level here, and I will be looking for a move back down to 1.0650 and potentially down to 1.0600. That would be my obvious target. If that breaks, then you're looking at potentially 1.0550. Very nice, simple. You can see there's condensing price action starting to develop here. You know, if this sort of breaks higher between now and tomorrow, then that could be a fantastic opportunity to short the euro US dollar if we get inflation coming in above 7.1 and above 6%. That's what we need, okay? Could be fantastic. So that's the simple way of trading that. As well as euro US dollar, the other option is you could trade the S&P 500 short. Why? Because higher interest rates means less conducive opportunities for traders. And you see this large bullish engulfing bar on the weekly chart. You know, that's an ideal place to sell and potentially looking for a move down to that 3,600, 3,650 region. Okay, good opportunities that are potentially there and are definitely worth looking at pretty, you know, pretty significantly. That's the area, incidentally, where I'll be buying longer term, regardless of what's going on. If price moves down to that area, I think longer term that looks a lovely region for the S&P 500. Slight aside, but just mentioning why that level's here. That will be a decent target. So, but I also think there's opportunities to trade the dollar short. Now, also expect gold to fall lower as well. Now, gold is quite elevated. So if we did get high inflationary print, could also look to trade gold lower. And, you know, if that puts in a false break of that bar to the upside, then, you know, a return to 1840, 1850 would definitely be on the cards. I also think there's opportunities if this is really a big miss. So if we see inflation coming in below 6.3% and core inflation coming in below 5.5, now the core is more important than the headline. Now, that's not just because the core is more important. It's because I've noticed a few central banks around the world, a few countries around the world have started to see a stickier core. So the cores will be in focus. So in other words, a big miss in the core data, and that's a big tick. So if I see the core coming in below 5.5%, that's a big tick, and I wouldn't be surprised to see a little bit more dollar selling, because that means that the markets are going to be more confident that the Fed can cut interest rates. Now, the best opportunity that I see is either a euro US dollar upside or a pound US dollar upside. Pound's been quite heavily sold off. I wouldn't be massively surprised to see a run higher up in the pound, back up to that 1.2300, 1.2400 region. So a move up to 1.2300 on a big miss is acceptable in my eyes. Pounds, you know, a lot of bad news has been priced in for the pound. We've seen a little bit of a recovery. The pound is vulnerable to being very dollar driven, as it was all of last year, really. It was mainly dollar driven. Yes, there was bleak news for the pound, but remember the pound was just one of a number of currencies losing ground against the dollar. Yen lost a huge amount against the dollar. We also have the euro, Aussie, New Zealand dollar. So pound like to be dollar driven. A lot of bad news is already priced in. So any kind of good news or not so bad news would be an extra lift for the pound. They're meeting 1st of Feb. So a big miss here, pound US dollar upside, is attractive to me. Similarly with euro US dollar, you could see some upside there. The only slight thing just so you're aware of, and this is how I'm looking at this, the best opportunity is on a beat. High inflation is the best opportunity because we have seen positioning, you know, we've seen the markets positioning for dollar weakness over the last few sessions. Do you see? See this dollar weakness that we've been seeing, right? So it means a big surprise means we can pop back up that way. Dollar index, Dixie long, fine, right? And euro US dollar short is just exactly the opposite of this. So you can see here the euro US dollar, I've overlaid it. If you invert the scale, you see how the euro US dollar and dollar index follow each other almost to the tick. So, you know, the reverse of a dollar index long is a euro US dollar short. So what we're looking at here is to have in your mind clearly that the best opportunity is on a beat. So if it's a miss, yes, I'll still try and trade it, but I'm a little bit more nervous. If it's a huge beat to the upside, then I'm less nervous. I'm more confident in going back into recent ranges. So just to be aware of that. Best opportunity from a beat, higher than expected. Good opportunity still in a miss, but just be aware at what point, and this is a question, at what point does the market say, okay, we priced in 2 rate cuts this year, so the market, that's not telling us anything new, so we might see a retracement in the dollar before, you know, more serious sellers step in. Okay, so that's what you're going to be aware of. So as always, manage risk, folks. It's a ripper, right? It's, look, I'm really looking forward to the CPI print. We're quite confident how markets have been reacting. Managing risk as always, but the debate about the speed, pace, extent of Fed rate hikes has been a big focus of the market. So lots of people are very into this CPI print. So we should see some decent volatility around it. Folks, that is the sum of my webinar. I hope that this was helpful. Don't forget, I will be back on Monday. Looking forward to the next print on next week's data call, and I'll be getting us ready for that as well. And of course, we will be unpacking what this latest CPI print means, as well as what the University of Michigan print means as well. So we will be onto all of that. I hope you all have a very good rest of session. Thank you all very much for attending, and I hope you have a really good trading day. Yeah, Gavin asked the questions. In the event of a decent beat, could you enter Euro US dollar on a sell stop, as often much of the move happens very quickly? Right. Yes, you could. Now, what Gavin's saying, and it's a fair point, is say you got a beat, could you enter on a sell on stop? Yeah, you could. Now, the place to enter on a sell on stop would be on the break of this bar here. Okay, so it'd be entering at that point, sell on stop. The only danger is I would use, as a general rule of thumb, sell on stop, I'd have my sell on stop entry 30 points below market. And then I'd only keep the position if I got a beat in the data. So if the beat wasn't there, but I'm still in, you've got to have the discipline to get out, if that makes sense. So you can have a sell on stop, but if you get taken in and the data is wrong, get out straight away. The difficulty with this approach is that once you're in, psychologically, it's very difficult to get out straight away. Secondly, you have to be aware that of what data price you get. If you've never done a sell on stop before over big news data, then you might want to experiment with a very small position on the live account so you see how things respond. But it is possible, and of course, if you do get that beat, then great, you're in. You'll get a bit of slippage, that's just normal, and you might get taken out 1.0650, 1.0600, something like that. And stops would just be above that recent high, 1.0765. Okay, folks, thank you all very much. Take care, and I hope you enjoy trading the US CPI print tomorrow. That's how I'm looking at trading it, and I hope that's provided some color for you. Yeah, that's great, Kevin. Thanks everyone now. Take care. Goodbye.